Hi everyone, welcome to 23 Mile with me, Kayode Odelayan. It's a special session today because with me I have David Czarny, who is an investment banker, an M&A specialist, and has significant experience with private equity. So rather than the founder story, today we will be diving into the buyer perspective on exits and setting up your startups for successful acquisition. David worked for several blue chip investment firms, including BCG and Accel-KKR. It was while in these roles that he saw a gap in the market for mid-market software companies who had strong fundamentals but could not exit because they were not large enough. He partnered to found and run a software roll-up company where over a few years, the team invested in 10 software companies. Today, we will be hearing from David on his perspective as a buyer and how startups and founders can set themselves up for successful exits. David, welcome to the show.
Thank you. Thank you for having me. I'm excited.
We were introduced by Body, if I remember correctly.
That's right. Bordy reached out and said you should definitely chat to Coyote.
And here we are. 2-3 years ago, this would have been unbelievable. Literally an AI bot making connections between people, but I love it.
Yeah. It's pretty incredible. I've used Bordy a good amount, and you get some good conversations out of it. And I can highly recommend it. And I'm not getting paid, by the way, for this, but anybody listening who's using Bordy AI it's a very, very good tool.
Amazing. So which is probably one of the things we're going to talk about as well, your foray into software investing. Let's start at the beginning. You ended up right out of school working with this in private equity. How did this come about?
Honestly, I didn't know any better at first. I graduated high school fairly young. I thought I was going to be a football player. You get to business school and you realize, hey, people are talking about finance. At that stage, I didn't know anything about finance. Got lucky, got a few internships in the space, and one of them was at Accel-KKR, which is effectively a private equity fund, as you're saying. And they back then happened to just look for one intern in the London office. I somehow happened to get that. And then somehow got folks to say, hey, apparently this guy is not that bad, and kept me. So I became the first junior in the team in London. And it's been a fun 2 years there.
Which is remarkable because for those who don't know, private equity almost never hires at the bottom of the ladder. So you must have done something really good, much better than he's not bad, right?
I hope so. I do think folks were ready to take a bet on me, and I did work my way through it, to be fair.
I will come back to that on the work and the work ethic and how that could be very overwhelming at times. But there was something you said earlier on. You wanted to be a football player. How far did you get on that path?
I got through like 2 years. 2 years when I was a kid. I went through, actually play a few competitions back in Germany where I'm from, but it became fairly obvious fairly quickly that I was not meant to be a striker. I gave it a shot. So at least I can say I tried, but no, I didn't make it into Hertha Berlin, which is Berlin's best club, and within Germany, one of the worst clubs. So if you can't get into the one club, which is on the bottom side of the ladder, at some point you just realize this is not meant to be.
You talked about the weekends, the long hours at Accel-KKR. Again, is it really as bad as it is portrayed in the media?
There is a working culture which is rigorous, but that's also, frankly speaking, what you need to be successful in these careers. So if you have a perspective that working hard is not a good thing, you're probably also not in the right spot there. That's the truth. Because all people there, they're not being forced to work hard. They actually want to work hard. And really that's why I actually don't think it's a bad thing as people always make it out to be, because people actually more often than not want to do this. Of course, not always, but many do. For me, it was, I think, a bit of a unique instance by virtue of having been the only intern and the only junior afterwards, and I also wanted to prove myself, which is probably why I went a bit more towards the extra mile when it comes to work hours compared to your average private equity gig. But you're right. Most folks that want a 9 to 5 or 9 to 7 or 9 to 9 probably shouldn't look into that world.
You are the second guest back to back who came from investment banking world. My previous guest told me, if you cannot make it in investment banking, if you cannot give the hours investment banking requires, you cannot give the hours it takes to succeed in venture.
I think there's truth to that. I do think if you start your own thing and you want to be in venture, I don't think that's a 9-to-5 job either. I think it's actually very, very similar. It's for people who really, really want to build something big. And I think many love finance because, it's a risk-adjusted way of still working really hard and building something big. So there are definitely similarities. If you're scared by the hours in the finance world, I don't think you should start in venture.
So I spent 13 years in banking, most of it in leverage finance. I came into entrepreneurship with that mindset as well. For the story there, the first time I ever traveled on holiday without my laptop was on my honeymoon. Not because I didn't try, but because I was packing, got married the previous day, was packing to travel. And my wife said, "What are you doing with a laptop?" I said, "But I always travel with my laptop. I may need to work on certain things." And she's like, "It's only one of us going. It's either me or the laptop." And I was like, "Okay, fine." So that was probably the first and the only time I've gone on holiday without my laptop. But yeah, I enjoy what I do now. So I never complain about the hours.
How long were you in your career until you were able to put down the laptop for the honeymoon? Was it after a few years?
I was already about 8 years in. So I had juniors. I had people who could pick up the slack. I had built a reputation in the organization, so I could leave the laptop behind. To your point, I was in year 1 or year 2 as an associate and getting married. That laptop wasn't staying back.
Yeah, I get that.
But then what was the rest of your time at Accel-KKR? What was it like? What was a typical day?
Quite a lot of interesting things. I think on a high level, the way these private equity firms work and what my day-to-day was, look at companies every single day, and sometimes more in depth, sometimes on a high level, depending on where you are in the whole acquisition process. But generally speaking, your day is analyzing companies, speaking to companies, understanding what can we do with companies. Where's the growth story? Where's the opportunity? So really the day-to-day has been lots of meetings with sellers, with founders, with CEOs, lots of analysis, lots of expert calls. You do lots and lots of expert work because on the private equity side, you're a software expert, yes, but there's so many verticals in software, so many types of customers, and you can't know everything. So lots of the work is actually expert work where you really, really get smart on a certain space, on a certain area. So really the day-to-day has just been it's just learning. You actually learn the whole time, which is why it's a very interesting place to be, because you have this bird's eye view on many things, but a bird sees a lot. A bird doesn't see everything very, very in depth. So you try to really see everything from above and then go really, really deep with those companies where you really think there's an opportunity here. So what we did is the fund that I worked for, we acquired software companies globally. I was in the Europe team. Anything starting, call it 5 million in ARR, and we looked at, and a few, of course, fairly large transactions, a few smaller transactions. We also did add-on transactions. So really, it's been a wide range of companies that we looked at.
And it was part of, while working in this team, that you realized that sub 5 million ARR software businesses was an opportunity, right?
Lots of my day actually, as I was saying, was speaking to companies, and you'd be surprised at how often I'd speak to founders. They're at 2 million ARR, 3 million ARR, and you're like, man, this is a great founder, this is a great product, it's a great team. Financial fundamentals are amazing, but they're too small. They're too small. And again, it's like online dating in a way, because you keep swiping left. You just can't. It's all great, but it just doesn't work. It's just too small for the fund. And talked to quite a few friends, acquaintances in other funds, and they had a very similar realization, which is we're just doing these large deals. We're all fighting for the north of 5 million ARR companies, and no one's really aggressively going after the, call it, small cap market, where there are 2 million, 3 million ARR companies. A huge gap, and you actually have more companies, right? You have more small companies and you have less professionalized buyers. So the thesis was, hey, there's a whole gap. It started the SaaS roll-up. We're focusing on these SME software companies, They are at 1, 2, 3 million in ARR. They have a right to exist. They have a product that works. They have happy customers. Yes, they have not made it to 10 million plus ARR, but there's a reason for that. And actually, maybe you can help them get there. You can unlock growth, because oftentimes, right, you actually need to get to a certain scale to get acquired, to get investment. But really, the investment is what enables the scale. So it's this whole cycle between, if I don't get investment and I don't get folks to help me, I actually can't get there better. So we said, hey, let's actually enable that for these small SME software companies who probably have lots of potential, but they just haven't had the right backers, because there's just not much professional investment into 2 million, 3 million ARR bootstrap companies.
How did you go from this path that is super lucrative, that's super rare, and then you decided to leave? Take me through that thought process.
It was a very difficult thought process, because you're right. I felt good there. I was proud of my job. I was proud of my work. I love the team, and you're right. You are set for life in a way in that trajectory. And in many ways, though, I wanted to be a bit more entrepreneurial. I wanted to your point on working hard. At some point, I realized if I really want to work hard, which I do, I might as well work hard for me and give it a true, genuine shot, because I'm also seeing these exits, right, people are having, and I'm seeing how much money is also on the entrepreneurial side. And truth be told, that always excited me. So really, it was not an easy decision. My girlfriend at the time wasn't happy, but it was, I think, for me, the right decision.
Great. And can you walk me through what then happened next in terms of partnering to found this software roll-up? Did you try to go by yourself?
We came together as a group of guys. So I was on the investment side. Really, the folks that I did this with, they were more operator backgrounds. There's a product manager there. There was a engineer, a techie there. We basically came together as a group of, call it a few guys, where we said, hey, we have very complementary skill sets, and that together can actually enable this. So really, it started off that way with a group and some initial fun to say, hey, you know what, let's try this. Let's buy a company. Let's buy 2 companies and see how it goes, and hopefully we'll buy more with time. And we bought the first 2 companies. We actually grew the first one by 100% over the first year. The second one in double digits, also fairly high, not 100%, but closer to 100 than to 0%. And something clearly worked right, because it was a very operational mindset. We didn't come in with a private equity lens, which is you come, you buy, you put someone there to monitor the portfolio and call it a day. But it was very much an approach of, hey, we're coming in. And I was actually the only investment person on the team. The others were engineers, they're product managers. They actually understood the day-to-day operations of software companies. So after the acquisition, they actually got their hands dirty. And we actually said, hey, how can we actually invest in sales and marketing? Can we actually do demos ourselves? So it was very operationally hands-on, where we didn't just buy, we actually bought and operated. And that's where we saw quite opportunity, because many of these SME software companies, they're doing things amazingly, but they've done oftentimes this their whole life. They have not seen other companies. They've not seen what worked well with other industries. So there's lots of things that you can bring in if you've done this a few times.
So many things to unpack there, but I'll start with the very definition. I'll just let you very succinctly define for us what a SaaS or software roll-up is.
On the highest level is where you acquire software companies, and not just one, but really quite a few. And there are various ways of structuring a software roll-up. Some say, hey, I'm focusing on government software, for example. And then these are folks who will actively buy only software companies in the government space. That can, for example, be one angle in what the buyer usually realizes is certain synergies. Maybe they have government software experts there. They've done this for 20 years, and they're able to add value that way. They might have a network. They might have certain things they can bring in. For us, what we brought in was a few things, less so on the vertical focus. We did acquire software companies in various verticals, so also in government, also manufacturing, also in media. What we brought in was various centralized resources. For example, we had centralized HR and recruiting. Everybody always talked about them struggling to find good talent. So we centralized recruiting, making sure all our portfolio companies are able to then benefit of recruiting. We centralized some of the engineering functions, actually. We had a few engineers at the roll-up level, at the holding company level, and they acted like a SWAT team. So if a portfolio company all of a sudden has a new development project they need to support on engineering, we had a few engineers that they can simply have as a resource to help them deploy something. So long way of saying a SaaS roll-up is effectively buying software companies, but generally speaking, not just leaving them as they are, but adding some value to these companies. And for us, it was not via the one vertical, but rather about specific functions that we made accessible to all the companies that we acquired.
In terms of those deals, it's very clear what the upside is for you. What is the benefit for the founders or the teams that sold to you?
There are few. I think the most obvious one is money. They're getting paid when they're selling their company, but it's more than that. Oftentimes, really, the companies that we bought, they weren't your 30-year-old crazy entrepreneur who's trying to hit the moon with their company. It's actually folks who are looking for retirement. We've actually bought many companies from folks that have been doing this for 10, 15, 20 years, right? Oftentimes people think of software as this new thing, but software has been around for a very, very long time at this point. And they're very much software companies from the 90s. And these are often run by folks that are looking for retirement, so we're actually able to enable them to retire, especially as there are not that many buyers in the SME space. So that's one thing. The third thing I'd say that founders teams benefit is actually continuity. You'd be surprised how many companies actually close their shops at some point compared to actually getting sold. I don't remember the specific numbers, but there's a crazy statistic around how many actually close shops versus getting sold. And that way, right, you enable continuity for customers, for the team, for the business. Because the alternative is obviously the customer is stuck and doesn't have a product, the team doesn't have a job. So there's a whole legacy piece to it, which is amazing. And then I'd even said on the fourth side, which was not our thesis, but it actually was interesting how that developed, it's a new chapter. People get motivated by a new chapter because you actually have new vision, you have new goals. So you're actually able to truly also create, in my opinion, oftentimes with an acquisition, an amazing working environment for employees because they've been doing the same thing often for a few years, the same goals. And don't get me wrong, I'm sure that's great. But usually when a buyer comes in, the buyer comes in with a goal. And the goal is often, hey, we're going to grow super quick, or hey, we're going to integrate this into our bigger platform, or hey, we're doing something, right? Not many buyers just buy to do nothing. That's how often folks actually got interested and excited by a vision compared to being scared of it. I always thought people would be scared of an acquisition. And yes, it's a tough word, the word acquisition, people get scared. But if you actually have a vision behind it, you actually get to inspire people, which was a learning for me. So that's another thing.
Thank you so much. You mentioned earlier on that you very quickly did 2 deals and then you found early success. How did you go from 2 software acquisitions to 10?
We started off with these 2, and really we said very early, it's important that we don't just buy, it's important that we actually buy well and buy those companies where we can actually add value. And I think where we found early success is, truth be told, somewhat luck also, because we had great partners and great founders that we're working with. And we also had a qualitative selection, which is, do they feel like good people that we want to work with? I think that was actually a major piece. And the second piece where we found early success and how we got to 10 is because we actually, in our diligence, I think took a very atypical approach, which is we really tried to validate the growth angle. Can we not just buy a good company for as is? We also did that, but can we really grow this company? Can we really understand, are we solving a problem, and can we actually expand the size of problem, the solution that we're selling ultimately? So that we did that in diligence, and that's usually why I think we went into an acquisition being very bullish about the growth opportunity. And if you do it once well, twice well, 3 times well, right, on the investor side, people are saying, oh wow, they're onto something. And luckily, that means usually that you have investors saying, yes, you're doing something right, do it more. So really that way we got more capital, we raised more capital, and did more of that. So really we got from 2 to 10 just by virtue of having gone, I think, slow and steady You see many aggregators that just come and buy everything. We didn't do that. We bought fairly selective. 10 is still not little in 3 years, but it's also not, be surprised how many people just buy everything they see. So really it was a selective process. Every company that we bought, we made sure we feel bullish about, we can actually do amazing things with. And luckily, all 10 out of 10 times, all companies performed either with our base case or even better than our base case. And that's why we were able to scale.
I mean, that's an interesting point, around 10 out of 10 working. So definitely you were working an anti-power law thesis, so to speak.
So say that again?
Yeah, so, like you said, you're basically going into software with a PE lens where 10 out of 10 deals work out. Whereas typical VC investors get into that space and they have this power law mantra where they're fine for 9 of them to fail and they're looking for just one. But you took the opposite approach.
Correct. That's, I think, a fundamental difference between having private equity capital, or private equity mindset, I should rather say, versus a venture capital mindset. The venture capital mindset, as you're saying, is you shoot 100 times, and one of them is hopefully Facebook. And the private equity mindset is much more, hey, I will shoot 10 times, and all of them have to work well. None of them will be Facebook. That's the truth. None of the companies that we bought, we ever thought was a moonshot. Some we knew we could grow, but we were always talking growth in terms of double digits. We got lucky once or twice, or we actually doubled the company in a year or two, but that's not the norm. The norm with this mindset is you really make sure that yes, you can grow, but you care about your downsides. And because you don't have this one Facebook in your portfolio, you also have this one outlier, which then offsets various other potential failure points. So for us, it's important to buy well continuously and really to make sure that every acquisition is successful, because every acquisition has to return their own investment as opposed to them making up for other companies.
Awesome. And I mean, you talked about everything kind of working well, but I'm sure there were some deals that either had near-death experiences or actually, maybe had to rescue. Was this the case, or really, did you really just have all of them working out well?
No, you're right. There were always burning fires. Actually, there was always something burning, but luckily we were able to fix these fires, but they were there. They were there for sure. And various examples of that. I think one company that we acquired, we frankly speaking, I think underestimated the tech debt. There was quite lots of tech debt there, and we really had to go through a whole rewriting process that we didn't initially appreciate how deep that would have to be on the technological side, because there was just lots of legacy code there, and that was a burning fire. Luckily, what I will say is we were fairly agile in how we approached things versus just saying, hey, we're stuck with a certain mindset and we're stuck with a certain way of doing things, especially in the beginning. We said, hey, let's make sure all of them are successful. And if we're seeing there's more tech debt, we immediately were able to prioritize that over other things. And then we also reoriented and made sure we are working around new fires to make sure the overall investment case still holds. But on that journey where all graphs hopefully mostly go up and to the right, it's not a journey like this. It's a journey which sometimes goes in cycles, but into this one.
Amazing. Let's get into that whole thing. Actually, the core of the matter where I want us to kind of demystify this M&A process for founders. My experience, and I'd like to get your take before we dive into it, is that a lot of founders, especially in the tech space, software space, younger founders, older founders, almost are never really thinking about M&A. It's like this very foreign concept to them. Has that been your experience as well?
Yes. Most companies that we actually acquired, they were not your typical, call it VC companies, right? They're often bootstrap companies. So these were actually more often lifestyle businesses, which means they've been run a certain way for the last 10, 15 years. And an exit is nothing they planned for. An exit is at some point they realized, hey, I want to retire. Hey, I want to do other things in life. Hey, my wife needs a new house. They're finding they have a reason to sell. And then all of a sudden they're thinking about it. But you're right. Oftentimes folks, it's a decision at some point versus a long thought through process usually.
I mean, what is it in terms of maybe just slightly deviating a bit? But in terms of getting deals done for these founders, you talked about those advantages for them. Is there anything else you guys did to get these founders over the line? Especially in situations where founders are thinking, should I sell? Should I hold on?
For sure, for sure. There are a few things we did to get things over the line. Not always, often. And what I say by that is you often have sellers that are motivated to sell, so you don't actually need to get them over the line because they really want to sell. Sometimes, which is actually the better position for the seller, they can sell, they don't have to sell. This is always the position you want to be in if you have that flexibility behind the sale. And that is where you as a buyer often have less leverage because, well, the seller doesn't like your offer, they'll just keep running the business as is. So that is where we often had to get creative to really make sure we get things across the line. But of course, in a way that still it doesn't hurt our position and makes our investment case work. And I think sorry, go ahead, Coyote.
Yes, I just wanted you made a very interesting point that I wanted to dive into. You have a business that can sell, but does not have to sell. From from a seller's mindset, that is where you want to be. But from a buyer, those are also, I think, the most attractive companies, right?
100%, 100%, because they're working well, right? The guys don't want to sell usually because, well, they don't need to. It's working well. And yeah, these tend to be the better companies. I fully agree with you. And that's where the creativity is important to get things done. The creativity, and I'd almost say the relationship is super important between the buyer and the seller, especially to get things across the line when it's a company that doesn't need to be sold, and the value add. I think here what we often did very well is to convey what we're actually doing with our acquisitions, right? Oftentimes when the seller doesn't need to sell, they might still sell if they're seeing it makes sense for the company and for them. If they see that you as a buyer coming in, you're actually adding something versus just buying. You're actually adding operational experience. You're actually adding engineering capabilities. You actually have done product roadmaps before. You actually have a thesis on growth. You've expanded into other markets. So often our way of getting these companies across the line was really just emphasizing what our value add is and building that shared vision together, actually, because you come with an idea, you iterate, and you build this vision together of where you want the company to go and what you should be doing to get the company there. That's how we get folks across the line.
Staying on this point, how would you describe to say listeners who are maybe early stage founders, still early on the journey, how would you describe the main characteristics of that kind of company that can sell, is attractive to buyers, but does not have to sell? How would you describe this kind of software company?
It's a software company that's inherently healthy in terms of it's companies that don't necessarily burn much cash. These tend to be the companies that don't need to sell. It tend to be companies that have a track record with their customers, that have effectively stable recurring revenues. Those companies that don't need to sell are those where you have the same customer use the product for the last 5, 6, 7 years, and they will be selling the software to these customers the next 3, 4, 5 years. So really that's another component. If you have a track record with your customers and proven renewal rates, and you also aren't burning cash, you're actually profitable sustainably, these are the companies that, generally speaking, they don't need to be sold because the owners are okay to hold them into a longer horizon. I think many venture capital backed companies that I know your focus is on, oftentimes they tend to burn capital. Now that's a bit trickier. Especially as a buyer. Because you, generally speaking, don't want to continue burning after a transaction. You actually want to be able to make money, and that's difficult oftentimes.
There are three broad things I tend to see as making a company attractive. One is the customer, which you touched on. Customer profile, they've been there, you're selling to them. The other is like the products and technology capabilities. You also touched on that earlier on regarding you even having a team of engineers that can support. And the third is the people, the team of the acquirers. How do these three themes play within your decision making? And if there are any others, please pop them in as well.
Yeah, so let me actually focus on the first one. And as a buyer, the key fundamentals are, and then we'll do product and people. I think for one, I'd actually say we don't just look at customers, we look at customer retention. That's for us a key thing. We really try to understand what are the renewal rates, what's the gross retention. So customers are important, customer renewals are important, customer concentration is very important. You of course know the concept, but for those that don't know, if your revenue is made up of 3 customers, it'll be very, very difficult to find a buyer because there's just a major customer concentration risk. And if one of these customers leaves you, then the business is just a much smaller one. And most private equity transactions that are actually eroding value are those where customer concentration risks have been underestimated. That's actually the one thing which keeps killing good deals on paper, was when these large customers churn. So that's a risk which many, many buyers take much more serious these days than a few years ago. That's a piece. I think fundamentals, there's a few more fundamentals that are important before I go into product and people. What we looked at always is growth, which sounds basic, of course, but growth actually in recurring revenue. The difference is you can grow in total revenue, but if it's through consulting gigs or if it's through customization work, it's actually not the same quality of revenue. What you want to be able to show to a buyer is that you're growing in your ARR and your recurring. That is actually a more impressive metric than growth in total revenue. So we always used to look at that piece quite a bit, trying to decipher which revenue streams are actually contractually recurring and will be recurring for the next years versus consulting gigs, for example, or implementation gigs, which are often part of the revenue stream, but not the most retentive ones. That's a key thing on the fundamental side. Profitability we talked about, and don't need to discuss that again. I think on the product side, my belief, and take it with a grain of salt because this is just my belief. I don't know if this is the textbook answer, but I think it's difficult to have a true view on product if you don't go really, really, really deep into it. I think it always is easy to say, yes, it's end to end. We do this feature and this feature and we solve everything for the customer. At least the narrative is always a great product. I find it very difficult as a buyer to really understand if it's a good product unless I do real work. So I think here most buyers make a decision, which is either they do less of an analysis on the product or they go very, very deep. I think there's nothing in the middle. I don't think you can understand the product on a high level and based on that make a decision on product. I think if you really try to dissect it, which I think is the right approach, frankly speaking, you need to dissect it. You need to really speak to the customers. You have to speak to the market. You have to demo with the competitors. You have to understand what the features are that the competitors offer. And I think for someone coming in new into a company, it's very difficult to have a true view on product without doing proper work. And I'd always encourage proper work, and you want to make sure the other things check out. People is also an important one here. People has 2 dimensions, right? You have the founder dimension and you have the team dimension. I think the founder dimension is initially, of course, and the one which provides access to the deal, the transaction. The founder is usually the person who you speak most with, who you interact the most with. You need to have a true relationship with that person. If there's something off with the founder, we just don't do a deal. We've actually had 2 transactions where on a personal note, we didn't feel comfortable with the founders. It felt like they were not being transparent with us in certain conversations. And we actually didn't pass on the companies for the financials, which looked great, but it just felt fishy. To be very honest with you, it felt fishy. So it's really important that you have a relationship with the founder. That's of course the key decision maker on the selling side. And the second component of people is of course the team. Now the team, as a buyer, you rarely meet the team early. You usually meet the team, if at all, towards the end of the process. You sometimes meet a few key folks, key management, but it's rare that you meet the whole team. Sadly, I'd love that. But of course, M&A transactions aren't done until they're done. And many sellers are trying to prevent any surprises to the team, that they don't want to announce a sale and the sale doesn't go through and people look for other jobs. So often the team gets shielded from the M&A process, which is unfortunate, but that's just a reality to actually protect the team, protect the business interests. Because hey, if they now think there's a buyer, now it goes off, they look for other jobs. Because what's important is so that you actually have a founder who trusts their team. If you work with a founder who says, oh, and I'm doing this, and I'm doing that, and I'm doing this, and they actually are putting themselves in front of the customer. They are the head of sales and also the head of customer support and the head of engineering and also the head of this and head of that. But they don't have a team that actually they trust in the delegation process. That is a red flag. So we as the buyer, we often don't have the access to the team, but you can still make certain assumptions based on how the founder works with the team.
Thanks for that. Before going into the process itself, I want to kind of summarize what I've kind of heard, looking at it from a seller's point of view. So let's assume I'm a tech founder, and I've come to that realization that getting to IPO is a one in 2,000 occurrence. So I want to set myself up for life-changing exits. Maybe a $20 million, dollar into my pocket exit in 5-6 years. So if I wanted to set up a software company today to achieve that goal, what I'm hearing is if I can bootstrap it, that's fine, because that then ticks that box of not burning too much cash. Otherwise, raise as little as possible. So seeing that, and then those three things we talked about. Is that correct in saying if I can build a software company that has, that is great on the cash burn, has great customers, repeat customers, has a very good product that fits into the customer growth segment, and has like good people, that is a winning formula? Or how would you put it?
If you're able to do that, I think that's a winning formula. If you're able to bootstrap a business and get it to a 20 million exit, I think that's great. I do think it's a trade-off because if you're bootstrapping this, it's not that easy. I've heard so many stories. I've not been a bootstrapper myself, so I can't speak for myself. But I've bought many bootstrap businesses, and you hear their war stories and the things they've done on the way to get there. And it's remarkable. And these are really people, they're not raising money to burn into a stack of cash which isn't theirs. They're actually putting their own money into this. They're putting their own sweat and tears and hours into this. I think it's a very, very difficult journey to bootstrap. Now, on the other side, you're fully right. If you successfully bootstrap and you are able to achieve an exit, which is 20 million, as you're saying, on the company, you are able to genuinely have a very large amount go into your pocket. So I think there's a certain amount of risk reward ratio, which I think folks just need to think through of what they want in life. I do think if you raise venture money, there's a different risk reward type metric which you want to think through compared to bootstrapping. Bootstrapping is it's you and just you, and if you're lucky, it's you have a partner, and if it doesn't work well, it doesn't work well. This is what it is. And I think many founders, they love the whole idea of raising money and raising venture money because they're building on someone else's risk. Well, in that case, of course, these are then firms who also want to be compensated for the risk, right? If I'm a VC and I give someone $3 million to start off with, well, I'm going now into the risk. So of course I want something of the bigger pie once it's being sold. And that's why these liquidation preferences for the VC, they make sense because they're the ones that are going into the risk by giving you the money to start off with. So why shouldn't they also participate in the upside? So it's really a question for every individual.
At the risk of spending too much time on this, but I think it's an important point because it's something that bothers every founder. It's one of the first decisions they have to take, but it's also one which will bother them for all life of the company, how to finance the company. These days, I'm hearing things like seed trapping, where founders raise maybe some grants, some angel investment, maybe a seed round with an intention to stop there. Have you seen some of this work out from your perspective as a buyer?
Truth be told, don't really have too much knowledge on seed trapping. I've heard this concept too. The companies that we always bought were bootstrapped, and I know the concept, but I don't have enough examples to be an educative talker about that topic.
To your point, bootstrap, it can work, but choose your hard, right? I mean, I think that's maybe how I can summarize this. Whatever path you choose is going to be hard, but you just have to choose that. In terms of the M&A process, across that whole gamut from introduction to getting the money in the bank, in which of this, where in the middle do you see founders slip up the most?
So I think there's where do founders slip up the most, and then there's where do deals die. I don't think that's the same thing. So where do deals die? Generally speaking, it actually tends to be at the top of the funnel. Most buyers, they have a certain investment mandate. What it means is they want to buy certain companies with a certain characteristic on a certain vertical, etc. And if you don't meet that characteristic, you will maybe have a nice intro call, you'll meet the team, you'll have a second one, you'll be treated out a little bit. But if you don't meet the criteria on either growth or revenue and profitability or team, whatever it is, it's not a fit. So that's actually, there's a whole, it's a funnel. It's like sales, right? Also on the buying side, it's a sales funnel ultimately. So most deals actually die at the top of the funnel because it's just a lack of fit for what the buyer is looking for and what the seller has to sell in terms of their company. Now, where I'm seeing most founders potentially struggle with the sale, of course, then different to that. For us as a buyer, whenever we worked with a founder who was very transparent and said, look, this is what's going well, this is what's not going well, that's amazing because you actually have someone who's working on your team and they actually want to show you where the opportunity is. I think where some founders trip up to your question is trying to sell. Yes, you're trying to sell your business, but you're not trying to sell something to someone. You're trying to, of course, make it positioned in a nice way. You want to make sure the buyer feels comfortable with the business, etc. But if you are trying to hide the issues, most buyers will find them and they will not trust you as a result. So that is where I've seen folks make mistakes in the process. If you're not actively working with the buyer, but are just trying to sell, that is, I think, in terms of call it errors or founder issues, I think the easiest thing to trip up on in the process.
And where does this, so is this the kind of thing where there have been some promises made, there have been some, there've been some statements. I'll give an example. There's a deal I'm looking at now where I've seen the ARR is 2.5 million and they say they're profitable. I spent about 10 minutes looking into the transaction and I saw that there were a lot of account receivables. So, and then they were writing off. So what I told me was that the real ARR was probably half of that, but it inflated it by putting in sales that they could never get the money for it. Is that what you're referring to by trying to sell?
That's an example, because if you discover something like that, and you say, okay, guys, it's clearly something you've represented the wrong way here. Well, odds are it's not the only thing that will be represented a certain way. So that's usually where you want to, in my humble opinion, walk away earlier as opposed to trying to find the next 10 things which have been misportrayed. So that's, I think, the biggest mistake people can make on the selling side.
Do you have another example of what it really means to be trying to sell rather than trying to work with the buyer?
Of course, one example was, for example, someone trying to hide that a big customer churned. It's a simple thing as that. We asked about the retention and they just eliminate this one customer from the whole file. And we're just like, wait a minute, what do you mean you eliminate this one customer from the file? And we have another file where the customer was there. So they effectively churned, but he didn't want us to take a look at that. And then you just start walking away. You're just like, no. If that's something which is actively being hidden, who knows what else is hidden? That's another example. Or oftentimes adjustments, right? There's this beautiful figure called EBITDA. And there's this other beautiful figure called adjusted EBITDA. And adjusted EBITDA is whatever you want to make it, right? Oh yes, you don't need those developers anymore. And I've seen people add back the developer costs. Like, yes, you don't need the developers anymore when you buy the company. So your adjusted EBITDA is 1 million. Well, the developers are there. You're paying them. You're paying them to maintain your product. You can't just tell me I don't need the developers. And now the EBITDA is $500,000 higher because you're assuming that I don't need to keep the developers. So really, that's just where folks are trying to sell too much that it becomes an issue. And yes, I'm not saying tell the buyer every single detail of every single issue out there. That's, of course, not how you sell a company. You also want the company to be attractive to a buyer, but you want to be transparent. You want to not mislead folks. If you mislead folks, yes, you might have money quickly, potentially if you get away with it, but believe me, there are legal issues with that. And more often than not, you won't get away with it before the money comes in because buyers do their diligence.
Amazing. Thanks, David. Coming back to a lot of the things you said, it's looking like a very simple process. Everything you've told me now on that process kind of fits into the statement you made earlier on. A business that does not need to be sold will probably do very well in due diligence, right?
Generally speaking, there are always issues, I will say, even those businesses, because they might not have contracts with their customers. They might have a legal debate outstanding. So even those great businesses on paper can have issues that creep up in diligence, but they tend to be less comparatively. You're right.
As a buyer or as buyers in the past, do you prefer entrepreneurs and sellers that hire bankers to help them? Or do you find it's easier to work directly with a team without any consultants or bankers?
As a buyer, always prefer no bankers. I, as a seller, should always have a banker. Because look,
Huh.
as a buyer, generally speaking, you've done various of these transactions, right? You know how it's being done, you know where to look at, etc. You as a seller, more often than not, are doing this for the first time. And M&A is not rocket science, but it's also not something you can just brush off and get done with no experience. So really, if you don't have someone to represent your interest and you're working with someone who's done this before various times, odds are the deal will actually end up being more in the buyer's favor. What's good about having a broker, a banker, is that they've done this before. They know the rodeo. They know exactly what mistakes you want to prevent. They know exactly how to maximize value. They know exactly how to position certain things so you don't run into the issues we just talked about. They represent the sellers in a way that gets deals done, and also deals that are more favorable to sellers. Now, there are always good and bad brokers. I don't think every broker is the same. I think there's a huge range in quality of brokers, and I think the selection process is actually very important. But they often pay for themselves. And what I mean by that is, yes, they might cost a few percentage points of the transaction value. Odds are, though, if you run a structured process with a banker, they will be able to get you a higher valuation because they know how it's done. So they actually pay for their own fees more often than not. I, as a buyer, like an off-market deal where there's no banker involved, because I'm able to oftentimes get a better deal and hopefully get it done on my terms. As a seller, I think if I were to sell, I'd always want to have a broker, and I'd always want to have a broker which has a track record in my industry. That's super important. Super important.
Thanks for that. This has been awesome. But one final question. What's next for you?
So I'm actually launching something new now, which is also a roll-up. So I actually left the roll-up that we launched a few months back. I'm starting something new, starting a similar journey with a few nuances though. And too early to speak because we're still starting to build the foundations, but it's going to be a very, very similar type structure with an AI angle, but hopefully there's more coming out fairly soon.
Thanks for that. So maybe we'll get you back on this in another few months to talk about that process. Thank you very much. It's been great having you, David.
Thank you. Well, that was fun. Enjoyed it. All the best.